And we are back talking about asset allocation. What has been the trend in the first half of the year? What is the likely trend that we are going to expect to see in the second half of the year? And more importantly, where are we going to make money? Mr. Pius Muchiri has been in this industry for a very long time. He's been one of the people that we certainly look up to. He knows where the money is. He is the CEO of Nabo Capital. Pius, welcome to the show.
Thank you very much.
So
good to be here.
Where's the money? Where's the money sitting? where should we go and dig for it?
I think I was with some friends not too long ago, and we were just making an observation because we invest across the continent.
Okay.
That investing in Africa is a macro play.
Wow.
And therefore, during tough economic times, then you tend to find the fixed income asset class tends to do much better. So if you look at the first half of the year, the fixed income market has tended to do quite okay. The equity market, if we don't look deep into it, then also it looks like it has done well. I think at the beginning of the year, we were at about 2.2 trillion Kenya shillings in market cap.
Yes.
It's now about it was 2 trillion at the beginning. Okay. And now it's about 2.2.
Oh, so it's actually
about 8.6% up.
Wow, all right.
But when you look deep, then you realize that Safaricom is more than half of the market.
That's true. Yes,
and Safaricom has gone up by about 27%.
That's actually what's carrying.
So if you remove Safaricom, the entire market has actually come down by about 5.7%.
Wow.
So it wasn't really great for equity investors. The other asset classes also, we've tried to struggle. I think the real estate, you've seen there is not much movement in terms of prices, so you really cannot count on capital gains. But the rental yields are also at about 6%, which is lower than what you'd get in a treasury bill.
Very true.
The other asset class, private equity, it grows. The return is from a capital gain point of view. Then you need to look at the price multiples.
Okay.
And if you reflect that on the stock market, then you expect the price multiples not to have moved. At best. At best.
All right.
But now then you have to focus on earnings expansion, which hasn't been that much.
That's very true.
So when you look at it in totality, the fixed income investors have tended to win the last
for the last 6 months.
The last 6 to 8 months.
Okay. I like that you bring out the element of if you're investing in Africa. So outside of Kenya,
yes.
Are we the worst? Are we the best? Is there any other country that's doing better? Because I tend to find that we beat ourselves down more than we should.
Yeah.
Is there? What's the comparative?
No, I mean we are not doing bad relatively. I think when you focus on Kenya, then you feel like we're really doing bad.
Okay.
But we're falling in what we call mid-tier markets.
All right.
But I think the best performing market has been Egypt. And
this is both equities and fixed income?
Both equity, let me say primarily equities.
All right.
But also fixed income. Egypt has done very well.
Wow.
I think we are getting treasury bills at about 16.5%.
Wow. That's a very good return.
Very good return.
Extremely good return. And what's the currency situation there? Has it
very stable?
Very stable.
Very stable.
Wow,
actually,
16%.
if you put the macroeconomic indicators for Kenya besides Egypt, it looks much stronger than us. Yeah.
All right. So outside of Egypt?
Outside of Egypt, then the West African markets have done well. They have not done well. Basically, what you'd call the resource-dependent economies have not done well.
And this largely Nigeria?
Nigeria, Ghana, all those markets have not done very well. South Africa has also done well.
Oh, interesting. What particular sectors? Has it equities and
equities market? Equities market has done relatively okay. Not the best, but relatively okay compared to everybody else. Then East Africa, we kind of are sailing in the same boat.
All right.
So relatively speaking, I mean, we've only lost about 5.7% when you consider all stocks in, which is not so bad. Some markets have done much worse than that.
Okay. Yeah. Wow, thank you so much for that overview. I think just as we started the show, we're looking at the banking numbers and trying to get a sense. Yeah. Should you actually be looking at the rate cap conversation as a trigger or not? And just as we went on a break, you brought out some very interesting comments. What do you think about the banking valuation? Because Safaricom, it's the investment case for Safaricom, it's really more or less articulated.
Yes.
But the investment case for the banks, today they're trading at 0.88 times book. Yes. Is that a buying opportunity? What are the triggers? What are your thoughts around that?
Yeah. I think for me, my thoughts around banking, I go back to probably my entire investment career. And I would call this season 3
Wow.
as far as
I like
investing
that.
in
Season 3. Okay, season 3. That's a good one.
Yeah, because when I joined the industry, we were buying banks at about one times book
Okay.
value
All right.
maximum.
Can I ask when that was?
That was 2004, thereabout.
Wow. 1 times. All right. Okay.
1 times book maximum.
Okay. Maximum.
The very best.
Wow.
And then we went into another season where banks became very expensive. I think on average, a very average bank, you'd buy it at about 1.8 times. That's before the rate cap.
Okay.
Then the rate cap came, and the valuations you can see now is we are on average 0.88, and the most expensive bank is at about 1.5 times bank.
That's true.
That's worse than the average before the rate cap.
Wow, that's very true.
So if you look at the last 3 years, there has been a struggle to allocate into the banking sector or into the telco sector. And some of us in the industry, we actually took the view initially that the rate cap would not survive more than 1 year.
Wow.
And therefore, we allocated quite a bit to the banking sector.
So were you allocating when the prices are about 26?
Yeah.
Oh, wow. So you're saving the money. Okay, 26. All right.
Yeah. So the rate cap, again, did not change or was not repealed. I think initially we all thought this thing is just going to be repealed.
Okay.
I think there are two things about the rate cap. One is, rationally speaking, we shouldn't have the rate cap. We are in a liberal market, and therefore the market should be allowed to price itself. And I think everybody, and now the IMF, the Central Bank, the Kenya Bank Association, they've all put their voice into this, and it makes a lot of sense. I think where we have gone wrong is in the political consideration. What does it take to politically get this over the line?
Okay.
And I think now we've, as investment players, we've adjusted ourselves to the fact that we've probably found a new equilibrium.
All right.
We probably will not have a rate cap removed completely.
Okay.
But there may be some modification.
All right.
And I think you alluded to it, what sort of modification may be. But we are all open.
The jury's out on that.
The jury's out there.
Okay. Yes. So then do you see value in this sector? Or rather, let me ask it broadly. When you're looking at the NSC today, I like that you've brought out a different element. All of us have been focusing NSC 20 is on a 10-year low, so it's probably the worst. But really, we've only lost 5% in value from the beginning of the year up until now.
Yeah.
Is there upside in the second half of the year when you're looking at equities? Do you expect a trend of asset allocation to get into the equity space?
Yeah, I mean, I think the NSE 20 share index is at about 2,400.
Yes.
This is one of the lowest points.
That's true.
So logically speaking, this is the time that we should be buying equities. It's a buyer's market. And what we are really missing is what's the trigger?
That's a good point.
I really can't see the trigger.
Yes.
And therefore, people are continuing to allocate to fixed income or to hold on to fixed income, because at the beginning of the year I would have said the same thing. Okay. This year. This is the year for equity equity allocation. We're 8 months into the year.
Yes.
And
it's
we're still where we are.
So maybe fixed income is a safe. So capital preservation is really very important at this point in time.
It is. I think it's anybody who has cash is king.
Okay.
Because you'll have the flexibility to move from one asset class to another. We are really missing that trigger.
All right.
And I think that's what everybody is watching out for.
What would be a trigger in your view?
Look here, I mean, out of 60 securities in the stock market, the banks make a big constituent of that. So the rate cap could be a good trigger. And also the rate cap revision, if it's in favor to credit growth, then it means it would have an implication in expansion of credit to the private sector. Private sector would start growing much faster than what we've seen. Then the conversation would start changing.
Wow.
Yeah.
A lot happening. I mean, I'm just trying to put myself in your mind, but I don't think I have the capability to do that. Okay, so when you come back and you say capital preservation is important and cash is king.
Yeah.
And I like when we started the conversation, you did say that macro stability, or rather the outlook of macros, is important.
Yes.
How do you look at the macro of Kenya? How would you rank the macro stability of Kenya, or rather the macro outlook of Kenya today?
Again, it's an interesting question. It's simple and it's complex.
Okay.
It's simple when you just think about Kenya. For me, I tend to answer that question from the perspective of there's somebody who has $1 billion,
Okay.
and they need to allocate to frontier and emerging markets.
Wow.
If you have to allocate to frontier and emerging markets, then you have to speak relatively.
Okay.
And therefore, when you look at Kenya, we do have our struggles from an operating environment point of view.
Exactly.
But relatively speaking to all the other destinations for capital, I think East Africa still is a sweet spot for investors. One, because we are not oil dependent. Two, because you have largely diversified economies.
Okay.
Three, most of us are done with elections, so we have at least 3 years to go before
we start the cycle again. You don't get worried by the squabbles that you at times I get a bit concerned because there is always a squabble after a squabble, and it feels that the government or rather the political forces are focused on 3 years in advance, way earlier than has ever been the case, at least over the last 2 to 3 election cycles. Does that concern you, or is it just noise?
It does concern me. It's just that we have to keep our head on top and see the entire environment.
Okay.
So today we are talking about xenophobia in South Africa.
Exactly.
I mean, I don't want to be there.
Exactly.
We're talking of, the oil-dependent countries are still figuring out.
That's true.
How to break even in terms of their budgets. So when you consider all these factors, then you still see this is a good place to invest.
I like that.
Comparability.
Peacefully. So you must widen your scope and compare.
Exactly.
Okay, Pius, we take a short break and look out for the NSE closing bell. Don't go anywhere.